just around 2 minutes here until the closing bell and take a look at where things stand. The Dow up now 20 points. We want to bring in our panel. We have Scott Kimball. He's co-head of U.S. Fixed Income for BMO Global Asset Management. We're also joined by Ryan Detrick, LPL Financial's Chief Market Strategist. Ryan, let me start with you. Just this upward movement that we've seen in the market now for quite some time. We're wrapping up the first half of the year, heading in to the second half. Where do you think we head from here?
Yeah, thanks for having me back. But, this is typical year two kind of frustration. Yes, I know, up to, 14, 15% for the year. But you look back at history, guys, year two of bull markets tends to be choppy, tends to be aggravating. Right about now, if you look back like in 2004, for instance, and even some of the other year twos, historically 84, for instance, stock markets kind of just go sideways. Remember 2010, we saw a 16% correction. So what I'm getting at is year two of a bull market is normally positive, yes. The economy does great, but you tend to have more of a catch your breath moment. And honestly, I know the S&P is making new highs, but look at small caps and the Dow. I mean, those things kind of really gone sideways for a while. So we're not overly concerned. It's just kind of, hey, let's catch our breath. And one more quick one. Historically, when you're up at least 12.5%, for the year at the halfway point, like we're going to be this year, the second half of the year, guys, actually does really well, up nearly 10% on a median return. So it would, again, continue to suggest stick with the bulls here.
Well, let's take a look at where things stand here as we wrap up the trading day, because we have just around 30 seconds until the bell, and you're looking at gains across the board. We have the Dow moving to the upside, S&P holding on to gains, and Nasdaq up another 0.2%. Inside the Dow, we're seeing an outperformance from Nike hitting another all-time high today, trading just shy of its high that it hit in earlier trading of 156.39. Home Depot, Apple, Goldman, and Microsoft rounding out the top 5 performers within the Dow today. And taking a look at the sector action, technology, of course, outperforming. That's a big reason why you see the Nasdaq up 0.2%. Consumer discretionary and healthcare are also trading to the upside.
And that is what they call a wrap as we get the closing bell and we wait for him to pound the gavel to say we are done. Let's see where we're going to settle in these markets today. And we're going to be up on the Dow about 11 points. S&P 500 will also be up about 1.5 points. Nasdaq's going to be up 27 points. You heard Shauna talking about some of the sectors, but let's dump into the Dow because one of the stocks to keep an eye on, JP Morgan Chase is actually going to finish flat to slightly down. But we're getting all this news about the dividends that other banks are going to be paying, and it's one of the things we want to talk to our guests about. So let's go back to them. Let's bring Scott in as we look at this because there's a lot of talk about interest rates. And I want to, you point out that, and I interpreted this from your notes, so if I'm wrong, correct me, that we're wasting a lot of time worrying about the tapering, that the rate is really going to be below 1%, the real rate, for a long time. Am I missing something?
Not at all. That's been our position at BMO Fixed Income for quite some time. When you look at the U.S. interest rate market, we have to take into consideration that this is just really another chapter in what's been a continuing story of lower for longer interest rates. And that the Fed, in all of their messaging, yes, there's been some nods to the idea of tapering. You're starting to see on the now infamous dot plot, some pulling forward of rate expectations from Fed governors to maybe moving a hike closer than the market was anticipating. The real question that we should be solving for historically is what's the terminal rate for Fed funds? The reality is, as we look at all the forecasts we can see in the Fed language, market expectations, everyone is aligned that interest rates from a Fed perspective, yes, they may go higher, but our terminal value is somewhere below 1%. If we can't have an economy that functions and grows with interest rates that are still below 1%, we have a lot of more broad problems than we are acknowledging today based on where other risk markets are, stocks and credit in particular.
Ryan, as it stands today, we have stocks at record highs. Valuations, of course, have moved up pretty substantially. Is the market too expensive at all at these levels? Any fear of that?
Yeah, that's one of the concerns that are out there, no doubt about it. I mean, now, yes, prices are up a lot. Let's not forget, though, we've seen record earnings expansion, so far this year also. At the start of the year, S&P 500 earnings are supposed to be up like 16, 17, 18%. Now we could see almost double that, right, for the year. Going to see almost 60% earnings growth here in the second quarter. So stocks are pricey. I think. But to kind of build on the previous discussion, bonds are very pricey, right? So one of the big calls we've made have been coming on to you guys all year saying, listen, stocks will outperform bonds. And that's one of the big ways we're constructing our portfolios for our more than 18,000 advisors. And as we have the second half of the year coming, we still think that's the play, that stocks will probably do better than bonds the second half of this year as the economy continues to improve, open up, and it'll be led by those earnings, which will justify pretty pricey multiples.
We're just about at the end of the second quarter, right? But before we get there, let's go back to Jared Blicker. He's on the floor of the New York Stock Exchange. Jared?
What a coincidence, Adam. I just wanted to recap the quarter actions in sectors so we can see where we are. So on the Wi-Fi Interactive, guess what? Real estate, the best performing sector. Who would have thought that? Followed by tech and communication services. So mega caps really outperforming. Only utilities in the red here. Now, if we consider only the last month, we did see some weakness in the value and cyclical. So you'll notice materials down 6%, financials down 4%, industrials 3%. etc. So I think the next 2 weeks until we really get into earnings season could be a little bit dicey, and we've seen tech flows. So money is flowing out of tech right now. The pain trade, as a lot of people on Twitter have been pointing out over the last 2 days, is still in favor of tech against value and growth stocks, and I don't see that really reversing in the next 2 weeks unless we get some huge major development on the infrastructure front.
Scott, I want to get back to you about what investors do in an interest rate environment like the one we're seeing, because this is when you've got to earn your money, because this is a tough market. This is not for the faint of heart. And some of us might try to chase yield with high yield, but then we wind up getting burned. So how do you talk your clients off the ledge when they look at these interest rates going nowhere?
Yeah, I mean, the key thing is the word is discipline, which is that if you're using fixed income, particularly as part of a portfolio construct where you're using bonds as a way of diversifying and giving you a cushion against adverse moves in other assets, whether that's other parts of fixed income, such as high yield or equities or real estate, the idea is, again, discipline. Bonds have demonstrated that even though there might be some short-term breaks, overall, when we look at the fixed income marketplace, high quality bonds do diversify risk assets in the risk off environment. We see stocks sell off, we see bonds do well. If you're an income investor, though, to your point, you're looking at a 10-year treasury that's now back below 1.5%. You have to be cognizant of where you're going in the risk market, which is why we're telling people don't focus so much on the Fed for making your decisions. That terminal rate for Fed funds is very low. Focus on doing your credit work and understanding if you're getting north of 3% in today's market, where high yield is priced, where emerging market debt is priced, you are taking on some very systemic risks that have a pretty strong correlation with risk markets. So it's not free yield, but we do agree that towards the back half of the year, yield is likely to continue to do very well because there are, just simply from a fixed income perspective, there's more money than there are assets and bonds to buy.
Ryan, that housing number that we got out this morning, another strong read with prices moving to the upside, more than 14% gain. I guess, how is the market looking at this? Because there are some worries out there about a potential bubble in the housing market.
Yeah, that's true. And, look at some of the other housing data we've seen over the last 2 weeks. They've kind of missed some of those numbers. So you can make, honestly, kind of whatever story you want. But the truth is this, if anyone has a friend who's a realtor, you know that it's booming, really. And the prices are definitely booming. So is it a bubble? Is it 2006 all over again? Our base case is no. There's some other factors that we look at. Housing is one part of it, yes. But again, we talked about the earnings coming back in. We've talked about the fundamentals. There's still 10 million more jobs we need to create to make up for what we just lost during the last recession. So again, there are some frothy things that are out there. People are excited, right? Stocks are at all-time highs. And again, that's where it kind of comes in with the previous discussion. You want to have a little bond exposure, right? We're, again, overweight stocks relative to bonds. But again, that kind of helps you when you have that pullback, when your bonds do well and lets you stay in your stocks at the end of the day. And a well-diversified portfolio should continue to do pretty well going forward. But put a bow on it, we're not super concerned about housing right here.
Jared, I've wanted to ask you for the last hour why financials, why that sector took a hit. And we're going to go back to the New York Stock Exchange because with the news we got regarding the stress tests and then the dividend that some of the banks are going to be paying, it seems to me financials took it on the chin today when they should not have.
Yeah, well, I think in general, the value and cyclical trade was off today. So the standouts, those companies that bucked the trend, Morgan Stanley and Goldman Sachs, they really knocked it out of the park when it comes to returning investor money through increased dividends. Goldman Sachs by 60%, Morgan Stanley 100% increase in their dividend, and also increase in share buybacks. So if you look at the Wi-Fi Interactive here, yeah, it's a down day for Bank of America, JP Morgan, Citigroup, Wells Fargo. By the way, Citigroup is the only one of these mega banks not to increase their dividend, so they were off the most. But Morgan Stanley and Goldman Sachs, these used to be investment banks, and then they converted to banks during the global financial crisis. Interesting, they don't have the deposit base that the others do, although Goldman has been working on that. They're just pure, really still pure broker plays and bank plays in a number of senses. I also wanted to take a look at the energy sector because that was off today as well. But you take a look at the 1 month gains here for a lot of these names, they kind of buck the trend. Financials down, but energy still flying high. Crude oil just seems like an unstoppable force right now.
Ryan, let's dig a little bit deeper into the financial plays that Jared was just mentioning, because they certainly have come pretty far. We just had the Morgan Stanley numbers up there year to date, pretty significant gains. Do you think that there will be room to run in some of these big bank names at least, or will it be choppy trading like you're advising for more broadly speaking for the broader market?
Yeah, we do. And again, it's probably all about earnings. I know I keep talking about earnings, but earnings season's right around the corner. I mean, our banks usually report early in the season, and you tend to see those strong numbers. So we'll see what they report here in a couple of weeks, but that's there. And honestly, I know that the yield curve is starting to flatten a little bit here. Short-term rates are going up more than long-term rates. But our base case, second half of this year, we're going to see more of a steepening yield curve, economy coming back. That should be more of a tailwind for these banks, along with the things that we just kind of talked about there with the dividends and buybacks. That should be tailwinds as well. So all in all, we still like value over growth the second half of this year at LPL Research, and clearly financials and banks are going to be a big part of that if we're right, or you could say if we're wrong. But we're still siding with financials here as well the second half of this year on a strong recovery and higher yields.
Hey, Scott, I got to squeeze this one in before we hit the commercial break. If the Fed does begin to stop its purchase of mortgage-backed securities towards the end of the year, is that going to impact mortgage rates in any way, do you think?
Our case is no. If you look at the adjusted spread on mortgage-backed securities right now, you're in the single digits. There is not much fear in that market, even if the Fed steps back.